Most retirees and even many advisors still rely on a simple rule that's created over 30 years ago, and that's called the 4% rule. But what if that rule is outdated? What if you could actually spend 50 to 100% more and still never run out of money in retirement? Whether you're 5 days from retirement or 20 years away, this video will help you answer the two critical questions. Number one, how much can you safely spend in retirement? And number two, when is the right time to retire? So stick around today because getting this right could mean retiring sooner and living better.
And welcome everybody to the Retirement Elevated podcast. I'm Walter Storholt alongside Scott Dugan, and he is, of course, if you're new to the channel or to the show, has about 25 years of experience in the financial planning realm and is the founder and president of Elevated Retirement Group. And we always dive into retirement and financial planning topics on today's show. And Scott, this is a good one because the 4% rule, as you said, has been around for a long time, but its history is kind of interesting. And the thing that's sort of making the headlines here is that the original creator of this 4% rule, he's changing it and amending it now this 30 plus years later. And so we're going to dive into all of that, but that might be a great starting point. Let's go back to the beginning of where this all started.
Sure. And so if you look at the history of the 4% rule, was created in the mid-1990s by a gentleman named William Bengen. It was based on historical data from 1926 onward. And he tested thousands of retirement start dates to find the worst possible case, the retiree who would have run out of money the fastest. And that unlucky retiree was October 1st, 1968. As his conclusion, if you withdraw 4% annually, now adjusted for inflation, your portfolio would likely last 30 years, even in the worst market cycle. That's why the 4% became the safe withdrawal rate all the way back from the 90s.
So it's interesting to know that he didn't really take an average. He was really taking worst case scenario, kind of setting a floor.
Mm-hmm. Yes.
Okay. Interesting. Well, now 30 years later, he's kind of on a publicity tour, Scott, right? He's got a book coming out and he's changing some of the rules based on his old rule of thumb of the 4% rule.
Yeah. So the rules getting an upgrade. And what he's basically said is that we can spend more. And in his new book, A Richer Retirement, Supercharging the 4% Rule, he found that adjusting portfolio design and withdrawal flexibility can safely raise the rate closer to 4.7% if you look at a consistent rate, or even more in certain cases. So what that means to you is 20% or more income for the same portfolio size or retiring a few years earlier. And so you're seeing this become more and more popular information, and it's going to find its way, into day-to-day planning at some point.
Yeah, at first blush, 4.7 doesn't sound that whole big of a deal different than 4. But when you extrapolate this out over years and with large retirement accounts, the noise is realistic and makes sense for why this is kind of drawing some eyeballs. What's happening, though? Why is this math changing? Why is he able to kind of give us this more freedom on this rule?
Well, I think it's a changing landscape for one thing. We've got different investment assumptions for equities and fixed income. And we're also taking into other factors. And in his book, he outlines 8 factors. And again, not rules of thumb, but there are 8 factors that can dictate, should you stay closer to that 4 or 4.7? Can you go up higher? And you hear these numbers batted around a lot. Dave Ramsey recently had a video, talked about taking out 8%. Well, there could be some truth to what he was saying in very specific situations. That is not a new rule of thumb that everyone should stick to. And
definitely don't do it blindly, right?
No, not at all. In our situation, in our planning process, we really look at what does our client need from their portfolio to make sure their job stays optional. And so it's very customized for each person. So let's talk about the 8 key factors that change the math when it comes to taking money out of your accounts in retirement. So the 8 rules, number 1 is Mengen talks about your withdrawal strategy. And if you've listened to our show before, you know that we really have 3 strategies that we employ. And it's looking at when we're trying to fill that income gap over time above your Social Security and or pension, really there's 3 types of families. And they're going to be, hey, I'm good with a market-based withdrawal strategy. And the market can go up and down, but I'm okay with that flexibility or up and down. On the opposite end of the spectrum are families that want more of a protected or guaranteed strategy. They want that to come in like clockwork. And the third type of family is really a hybrid of those two, saying, hey, we've got a $4,000 a month income gap. We're okay with half of that coming from a flexible, strategy like the market, but we'd like the other half to be rock solid and guaranteed. So really that withdrawal strategy is really going to depend on how you feel about risk, the size of your assets, the need of money from that. So again, that's going to be customized to every person. The second thing we look at is what's your time horizon. If someone says, hey, we're going to live, we've got longevity in our family, we're going to travel, or we're going to retire early. Well, you may have a long time horizon to plan around. And so starting out of the gate at a very high withdrawal rate is probably not smart if you think you're going to sustain that. Now, if someone says, hey, we're going to take the go-go years, that whole idea of the first 10 years to go-go, that's going to be our highest distribution. That's how we're going to take the most amount of money out. And then we're going to taper it over time, taper that off over time. And that's what, if you look at historical facts in the JP Morgan study, that's what happens. Go, slow go, and then no go. The third factor is the tax type of your accounts. Have you been saving like most people? Most of your wealth is in that tax deferred account in your IRA or 401k. I mean, you're going to have to pay taxes when you harvest and reap the rewards from all your hard work, because you take out $1 from an IRA, you don't get to spend that entire dollar. You get to keep a percentage of that. If you have a Roth IRA, you get to keep all of those dollars. If it's in a non-qualified account or a brokerage account, there's some tax strategies around that. So again, understanding what the tax type is and how much you have in each is crucial when putting together your retirement income plan. Number 4, do you have legacy goals? When I started 20 plus years ago, it was very important for people to leave a legacy, to leave money to their kids and or grandkids. And that is still important in some situations, but I think it shifted because you're talking about a pension generation. And now the 401k generation, they're saying, hey, we put our kids through school. Maybe we helped them get their first house. We want to do fun things along the way with them, create memories. If our last check barely clears the bank, we're okay with it. All right. So they don't necessarily have big legacy goals. But if there is money left over, they want to make sure it passes on in the most efficient and effective manner. And number 5, asset allocation. How many baskets do you have? How many eggs do you have in each basket? Are you conservative? Are you aggressive? Somewhere in between? That makes a big difference on the withdrawal strategy you're looking at. Rebalancing frequencies, number 6, that helps out tremendously. Every 90 days, rebalance that portfolio, making sure you're between the guardrails. Number 7, what are your performance goals? Again, we ask that question when families come in to meet with us for the first time. What are your goals? What are you shooting for? What are you comfortable with? And number 8, extremely important, your timing of your withdrawals. And so when are you going to start taking those withdrawals? Are we going to take out most of your income from your savings and delay your Social Security? Or are we going to take Social Security early and lessen the withdrawal from your savings? So again, all those 8 factors, there's many more details that go into it, but he does a great job of explaining in detail those things that you really need to get a hold of when you're planning for a solid, predictable retirement.
Is your retirement strategy working as hard as you are? Get the answers you deserve with Elevated Retirement Group's information-packed toolkit. Inside, you'll get Scott's book, Exceptional Retirement, along with essential insights covering the 5 key areas of retirement planning, strategies to keep more of your hard-earned money, and how to choose your winning retirement team. Take control of your retirement today. Click the link in today's show description to claim your toolkit at no cost to you.
The thing that really resonates with me, as it does on many of our episodes, Scott, just the amount of levers that we can pull here. So you start to see how you can understand, okay, we have a floor in that 4%-ish area, whether we go by the old rule or the new 4.7% rule, and then sort of the Dave Ramsey tossing out the 8%. You can see why there's now this variance because we have so many different levers and so many different directions that we can go to. And to that point further, you have highlighted this already on the episode, but let's give some more context to it. Why you hear 4% and may think, okay, too conservative, which I think would be a lot of good news to people's ears.
It is. And really that if you look at what was the aim of the 4% rule, It was aimed at, for a 1 in 1,000 chance of failure, and basically zero tolerance for running out of money. But most retirees don't need that extreme level of security. Many would be comfortable with a 90% success rate, knowing they could adjust slightly if needed, spend less 1 year, or work part-time briefly. The key takeaway is flexibility increases sustainability. And in previous episodes, we talked about you're going to have variability of cash flow needs during retirement. And that's a great episode to go back and listen to. So we need to make sure we plan around that. And again, that 4% rule, if we're locked into that, we have clients that if they retire early, their first 2 or 3 years, we may see a 7 or 8% withdrawal rate. But we know it's only going to be for a 2 to 3 year period until we activate Social Security or do other things. And so really that real world range we're talking about is that 4 to 8%. Bengen's case study shows withdrawal rates between 4.7 and that 7 to 8% range, depending on factors like health, life expectancy, investment aggressiveness, and willing to adjust spending. So again, are you willing to tighten your belt when the economy and the markets are down? And then we talked about Dave Ramsey. His 8% rule might not be as ridiculous as critics claim in the right circumstances. But again, it's not a blanket recommendation everyone should follow just to start, distributing 8% for the rest of your life when you retire at 62.
Well, the one nice thing about the 4% rule was you just kind of set it and forget it, and it was a nice round number, and now we're moving away from that a little bit. So how can we put this kind of into our real lives as investors and savers and retirement planners to kind of leverage some of this new information and data that's been coming out over the last couple of months that you've covered, and we talked very in depth about, spending changes in the world out there for retirees, and now kind of this other side, this withdrawal section of the equation that Bengen's adjusting and changing here.
Yeah, so really instead of using a generic spreadsheet, retirees today can use dynamic planning models. So those are really tools that simulate different market returns, inflation paths, and
don't try to get rid of my spreadsheet, Scott. Come on now.
Those are fine, but I can tell you they're going to be hard to compete with some of the technology that's out there.
Fair.
And really, these models allow you to test what-if scenarios before you make big decisions. But the most valuable insight comes from working with a fiduciary advisor who could integrate your income sources with plan withdrawals for tax efficiency, and also stress test your plan for longevity and market volatility. You've got to be able. You can't do that with a spreadsheet. The second question Bengen raises: when should I retire? Because how much you can spend is only half the equation. Timing retirement while you still have health, energy, and purpose can be the difference between enduring retirement and enjoying it. If you're planning retirement, don't rely on outdated rules of thumb. Let's help you find your safe withdrawal number by using the most updated financial planning software out there, not just spreadsheets. And if you click the link below, schedule a discovery session with one of our advisors. They're going to walk you through our process, help you get through those 8 questions that Bengen talks about, and make sure that you're on the right track to get to or through retirement.
It's just really important these days to go through a more in-depth process to plan for retirement. You look at that history of retirement planning that we've talked about on prior episodes as well, and you start to realize that this was really kind of a done-for-you thing when it first came out, and now so much of the burden is on you, the individual, to plan for your own future. And hopefully you've done a great job saving for retirement, but that responsibility doesn't change once you get into retirement. So as you prepare for that transition, make sure you're still taking that onus, that responsibility to make good choices, put the right plans in place so that you can live your retirement with the kind of flexibility and reaching the kind of goals that you want. And again, like Scott said, there's a link in the description of today's show where you can book a call with a great member of the Elevated Retirement Group planning team and see if you're a great fit to work with one another. All you have to do is click that link in the description, schedule that time to visit. It's also always at listentoscott.com if you want to go straight to the URL as well. Thanks for watching and listening to today's show, wherever you joined us from. If you're on YouTube, don't forget to hit the like button and subscribe so you don't miss future episodes as well. Scott, thanks for all the help today and for breaking down the book and some of these new developments. And we'll look forward to kind of keeping an eye on how this transpires and changes retirement planning a little bit in the coming months.
It's going to be interesting for sure.
Yep. We'll see everybody next time right back here on your Retirement Elevated.
This podcast has been prepared for educational and marketing purposes only. The information in this video is general in nature, does not constitute personalized investment advice, and does not provide a complete analysis of the subjects discussed. All investments involve risk, and different types of investments involve varying degrees of risk. There can be no assurance that any specific investment strategy will be profitable or suitable to you. Additionally, although information presented in this podcast is believed to be factual and up to date, we do not guarantee its accuracy. You should consult an attorney or tax professional regarding your specific legal or tax situation and should consult a professional advisor before implementing any of the strategies mentioned in this video. Investment advisory services are offered through Elevated Capital Advisors LLC, an SEC-registered investment advisor affiliated with Elevated Retirement Group LLC. Registration as an investment advisor does not constitute an endorsement of Elevated Capital Advisors LLC by securities regulators, nor does it indicate that the firm has attained a particular level of skill or ability. Insurance advice and products may be offered by a third-party insurance producer, which may be affiliated with Elevated Retirement Group LLC and Elevated Capital Advisors LLC. Walter Storholt, Mark Killian, and Third Wheel Media LLC are not clients of Elevated Capital Advisors. They receive cash compensation for their assistance in preparing and hosting this podcast, and for providing the endorsement contained in this podcast. Because Walter, Mark, and Third Wheel Media are compensated in connection with this podcast, they have a material conflict of interest in providing their endorsement.